In last week's episode, I had mentioned that I would go over stock allocations this week. Today, we will talk about what stock allocations are all about and the different types of investments that you can make to build your stock allocation. I will also go over what our specific allocations are and why we chose that specific investment mix.
Let's go.
So, what is a stock allocation exactly? You can think of stock allocations as a big basket, and all the different investments that you make are envelopes that you fit inside that basket. Each allocation will have a certain amount of money that you'll put in each type of investment. And essentially, that whole set of investments form your portfolio. There are many types of investments that you can make. The most common ones are index funds, growth funds, value funds, international funds, bonds, and more speculative investments such as cryptocurrency. An index fund basically is a fund that represents the entire S&P 500. Basically, it represents an ownership in each of the companies that make up the S&P 500. So, for example, instead of owning individual stock, Amazon, Tesla, Microsoft, you'll be owning a piece of each of those companies if you buy an index fund. Growth funds represent companies that are expected to grow at a high rate of trajectory, meaning that they're targeted to grow super, super fast. These companies include NVIDIA or any of the AI companies that are out there. These are usually technology companies and innovative companies. There's definitely more potential for gains with growth funds, but there is a higher risk and therefore a lot more volatility. Value funds invest in established profitable companies that are usually undervalued. You can think of these companies are those that provide staples and basic goods and commodities. When the market goes down, value funds typically hold their value better than growth or index funds. In fact, one example of a value fund is SAHD. And in times when the S&P 500, for example, had gotten two-digit losses, the value fund SCHD only experienced less than 5% loss. And so they're a good investment choice to make to balance out some of the risk in your portfolio. My husband and I don't really hold a lot of international funds. And the reasoning for this is a lot of technology companies today, for example, Amazon, Microsoft, Google, they have a presence already outside the US. And so, in a way, you have already some sort of international exposure. And then finally, there's speculative investments. As I mentioned, cryptocurrency is one of them. And in the last several years, we have seen dynamic growth with Bitcoin, for example. But they are very speculative investments, meaning that the fund can go up and down many times in a short period. And so, if your risk tolerance is very low, I would stay away from speculative investments like crypto. Part of the conversation with stock allocation also relies on your risk tolerance. So, what is risk tolerance? Risk tolerance is really how much volatility and potential financial loss are you willing to accept, whether that's emotionally or mentally or financially, without panicking and making bad decisions. There's two parts of risk tolerance. One is your financial capacity for risk, meaning, can you actually afford to lose this money? For example, if you're 30 years old, you probably have a long runway before you need to tap into your account for retirement. But if you're 65, your risk tolerance is probably lower because you probably can't afford to have a 30% drop in your portfolio if the stock market goes down. The second part of risk tolerance is emotional, meaning How do you feel when your portfolio values start dropping, say 30,000, 50,000, 100,000 in just one day? Some people see this as a buying opportunity and will buy and stay calm. However, other people panic and they can't sleep, and then they sell everything while they're at rock bottom prices. This is definitely not good. Both of these reactions are totally valid, but you need to decide upfront which one you are. So here's a test. Ask yourself this. Imagine you check your account and it's down 20%. Let's say you have a $1 million portfolio. So now you've just lost $200,000. If you have high risk tolerance, you probably would say, okay, market's on sale. How many more of these stocks can I buy? That means your tolerance for loss is high. However, if you have moderate risk tolerance, you would probably say, oh, this hurts. I'm just going to leave it alone and just wait for the market to recover. If, however, you have low risk tolerance, you would probably say, well, I'm not going to take this. I'm just going to take the money and run, or I'm just going to sell before I lose more money. Your honest answer will tell you what your real risk tolerance is. The reason why we do stock allocation is to build diversification in your portfolio, meaning that you want to have different types of investments inside. That way, when the market shifts, when one stock goes up, another goes down, and maybe all of them go up at the same time, but you just don't know. If all of us knew, we'd all be millionaires today, wouldn't we? But we don't. There's really no prediction on how the markets will turn. And therefore, you hedge your account against volatility by building diversification and allocating funds into these different classes of stocks and funds. Next week, I will go through our financial regrets and discuss things that I wish I had known now after decades of investing that I'm hoping people who are listening to this or watching this will learn from. So until next time, we'll see you. Thank you. Bye bye.